And you know, we talked a little bit, I'd like to get your input on how you really can't time the market when it comes to real estate. You know, we only see the turn when certain indications come, and that's when we are actually have to jump in and get in and get our buyers to get off the shelf.
Well, and speaking of market timing, which is kind of interesting, is it almost looks like a smiley face with a line through it, and people never know that it's turned until after the fact. It's historical. Mm-hmm. So when I looked at some analysis just out of curiosity, and so since rates have gone up 0.5% to 0.75% recently, and then I started looking at what does that affect as far as the buying power goes. That's somewhere in the range of each 0.5% is representing somewhere between $7,500 and $8,000 of buying power.
On a $150,000.
On a $150,000 house is the one that I kind of used as a benchmark, which would be a typical price range for a first-time home buyer, somewhere between $150,000 and $200,000, maybe some of that nature. So when you start looking at where rates were just as recent as November of last year, before the government started buying a bunch of mortgage-backed securities, then rates were at about 6.25%, 6.5%. So each 1% in rate is representing, $13,000, $14,000, $15,000, somewhere in that price range of buying power. So I think people are starting to understand that rates aren't 1% to 4% anymore, and the mechanics aren't there and they aren't in place. And there's only a certain amount of demand for mortgage-backed securities, and that's what's driving the lower rates. So we're in a perfect situation right now where rates are still tremendously low at 5.25%, 5.5%. First-time home buyers, we look at still there's a good amount of inventory out there that first-time home buyers can take advantage of getting into their first house, even move-up buyers for that respect. And then the third thing is this tax credit, this gift from the government of $8,000, which is basically just goes right to their bank account. It's a phenomenal situation.
One of the neat things about what we're talking about is that the move-up market, say between 200 and 300, 325, has not seen that same movement towards a seller's market. Mm-hmm. So if you're getting out of your first home, selling your first home in a seller's market, 150, where you're able to get, like we talked about, multiple offer situations in some cases, and get maximum dollar return on it, and then you're moving into a market that is that's still recovering and still a buyer's market. The difference is that you're going to get an incredible jump in equity when you move to that higher property, because the higher properties still are competing for the same buyers. So as they come out of their first time home and go to the move up, I think you're going to see people be able to really improve their equity situation by taking that move.